All right, Roger, welcome. Excited to have you tonight. It's actually second time, right? You were here before
Many moons
years
ago.
ago.
Yeah.
Yes. So managing partner at IA Ventures, and first of all, congratulations. You were recently named to the Midas list, the Forbes Midas list of the top 100 VCs, and also the New York Times list, also of the 100 VCs. So
Thanks, Matt.
yes. I think that's pretty cool.
Thank you.
So, by way of background, so you started IA Ventures in 2010?
Late 09.
2010?
Yeah.
Okay. And before that, you had an illustrious career on Wall Street, 17 years on Wall Street. What did you do there? Like, it's trading of options?
Yeah.
Or?
So it was principally in derivatives at Citi and Deutsche. And then I ran a large proprietary trading business called DB Advisors out of Deutsche for 3 years.
And before that, you were a proud Michigan...
University of Michigan, Wolverines, baby.
Actually, I read on some social media, like your second son just got in as well, so like all your...
Exactly, so both my boys will be at Michigan. I met my wife at Michigan. Sister went to Michigan. Grandfather went to Michigan. You can see a trend here.
The colors of the
exactly,
the
the blue glasses.
Congratulations. So to the Midas list thing, so you had like a nice couple of years, right, including the IPO in September 2016 of the Trade Desk.
That's correct.
And then do you want to talk maybe to start with that story? Like, how do you because you invested very early in that, right?
Yeah, it was basically the founder Jeff Green. He was the co-founder of AdECN, which had sold to Microsoft, and he didn't love the way that things were going there, and he thought he could do it better on his own, and he came to me with a PowerPoint and an idea for reshaping the programmatic landscape in the summer of 2009. This is actually before I started the firm, and we kept on talking, and it was, I think, the second investment that we made out of IA Fund 1, where we actually co-led the seed round with Founder Collective, and then we bridged the company 3 times, participated in the A, participated in the B, and by the time the company IPO'd in September of 2016, we owned 19% at IPO. So that was pretty exciting for a relatively small fund, a Fund 1 out of New York, to do that. So it was super, super exciting.
Then again, doing an ad tech deal in September 2009 when the world was falling apart. I mean, that took some serious conviction. And,
it's not clear that the world wanted another ad tech company at any point, much less that point. A ton of money, even among the New York and Boston VC landscape, had gone into ad tech. There were some very large DSPs, very, very well funded. But the thing that was so amazing about Jeff and his vision for the company is he was extremely, aside from having deep domain experience, he was extremely principled, ruthless on he was going to compete in this one very scoped area, which was providing agencies with the power tools to basically run programmatic strategies like Wall Street high-frequency traders. Many, if not all, of the other kind of next-gen DSPs adopted a strategy of competing with the agencies and going direct to the brands, and then leveraging a lot of services because there were very fat margins in that side of the business back then. We were happy to take a much lower take rate, but was all powered by machines. And at the end of the day, not competing with agencies, but powering them enabled us to pretty much power the entire buy side. And that was a game changer, as other competitors dealt with channel conflict, but we did not.
And then the other exciting exit recently was Flatiron Health. So we had the pleasure and honor of hosting Zach here maybe 2 or 3 years ago now. So terrific story and terrific New York story as well. Any story actually from that?
A little story. So I was also an original investor as an angel in Invite Media. So I had been introduced to them by, I guess it was Josh Koppelman, because First Round had led that round and we had done some investing together. So one thing that was kind of left out in the background is, so I was on the street from 87 to the end of '04, and then from early '05 to late '09, as I was setting up IA, I had invested kind of professionally as an angel and set up an investment vehicle called IA Capital and put a lot of money out. I seeded 40 companies, led 6 rounds, sat on 6 boards, very, very active in the angel community here. And so had met Matt and Zach and also knew a lot about ad tech and was extremely impressed because they had really articulated a strategy that was directionally similar to ultimately Jeff Green's and the Trade Desk, but they obviously, sold out much earlier to Google, but they're now, a huge part of their core infrastructure. So I had built that relationship, seen that successful exit. Then when they started Flatiron, we were, honored to have the opportunity to support them again.
Great. And so IA now you're on your third fund?
We're on our third fund.
Which is how large?
160.
160, right. And there's 3 partners?
Yes. It's Brad Gillespie, who was with me at the time that I started IA. He was a PhD in EE signal processing and machine learning, because I knew that I wanted kind of a scientist as a complement to, while I'm quantitative, I'm not an engineer by background. And then 2 years later, found Jesse Beiruti, who's our third partner, super smart, young man out of Penn M&T, master's in CS, Microsoft, Insight Ventures, and then joined us. So the 3 of us have been together now for more than 6.5 years, and Brad and I almost 9 years. And it's been great.
And it's interesting, right? Because you guys started as a big data fund, right? That was the whole initial positioning, and especially in 2009, 2010, that was very much ahead of the whole wave, so very visionary there. And you've evolved now to have a much broader focus. Is that because you can and you can raise money without that thesis, or is it a commentary on the state of data and machine learning and those things?
Sure, that's a great question. Certainly when I started the firm, having the notion of big data as an investable theme was novel and very powerful as a fundraising vehicle, and also just to help explain our story and our ethos. And it was absolutely true. And if you look at, the shape of IA1, there is a lot of infrastructure, security, ad tech, things that one would construe as being big data. And at the beginning of Fund 2, which was at the end of 11, early 12, that continued to carry on. But I think we found that having that kind of blunt lens, those guardrails, were overly restrictive relative to where we felt we could really both source and invest intelligently and to achieve the returns that we were shooting for. Ironically, as we loosen the big data constraint as such, if you were to look at the investments that we do now, tons of them you could easily say still fall within that realm. We just didn't want to be labeled that way, because when I started the firm, big data had one connotation, and then today, I don't know if I would say it's pejorative, but it certainly kind of evokes a whole frame that is not necessarily what we want to communicate at IA. So I think it's less a comment on that, ML or AI have disappointed and it's not a great place to be, or does the world need another high-speed database? But I think it's just now it's so ingrained in pretty much every single thing that you look at or I look at, it kind of doesn't mean anything anymore.
And to that point that a lot of what you currently do still sort of falls in those buckets. So I read somewhere some of the themes that were excited about, and so in no particular order, information businesses which exhibit data network effects, so including the Trade Desk and InfoSum and Signified. Do you want to talk about maybe data network effects, what that means, and why it's a desirable characteristic?
Sure. I think we actually have lots of businesses that exhibit data network effects where, as you add clients, as you add data into the system, that the system becomes better for all participants. And that creates a competitive moat that is insanely valuable and hard to fight against. So, and I think we've become more sophisticated about that as time has moved on, whether you're talking about something like, Signified and merchant fraud, and having an ever larger data set that enables you to make better predictions, and even in their case, to step into the shoes of the merchant and assume the risk, right? I mean, that's, I think, the next, if not the next frontier, it's certainly something where we've seen very powerful businesses be built where companies are actually stepping into the customer's shoes and saying, for a fee, we'll assume the risk that you've historically assumed, so you can focus on the thing that you're best at, like serving customers. And so I think that's one very powerful example of data network effects leading to companies being able to do things that were previously unimaginable.
Just to paraphrase, so that means that Signified, what they learn from one customer, the way interacting with customer X helps improve the algorithm, then help them offer a better product to customer Y. A
better price, assume greater risk, absolutely.
Okay. And so for people here building data businesses, do you see, how do you build that? I guess, building network effects is one of the hardest things to do. How do you bootstrap that and avoid the cold start problem? Or is that something that you need to think about when you're in year 5 of your business?
No, I definitely think it's something that you think about at the beginning. I mean, not every business by its nature subjects itself to data network effects. Those that do, I think, can be especially powerful and especially valuable. But I think it is something to think very deeply about at the beginning, as you are bootstrapping that initial data set, and you always have it's very rare not to have a cold start, but there are, obviously hacking that initial user base and hacking the initial data set to start to see, are there ways to leverage kind of the collective knowledge that you've accumulated in order to improve the product, whether it's the price, the risk tolerance, what have you. So yes, I think it is something that you should be very intentional about as early as possible.
Have you seen customers react negatively to this, saying, "Hey, I don't want you to, whatever you learn from me, to then go help my competitor or like some other company in the industry, and then what have your companies done to mitigate that risk?"
Generally, not in the companies that we. In the investments that we've done, there are certainly times, especially I would say, like in financial transactions, generally not, because everything's anonymized and it really is driving benefit for everybody. It's not, and the numbers are so large, it's not about specific records. But in things like, for instance, health tech companies that are looking to build panels with very, very sensitive data, PII. That's a very, very different set of problems, and needing to think about how to clean data that could potentially be merged. That is a very, very hard problem. And actually, I've actually made an investment in a company that specifically addresses that issue. Which is InfoSum, exactly, which is this notion of being able to effectively query multiple data sets, regardless of whether inside or outside the firewall, without actually moving data. So it's learning enough from each of the data sets independently such that you could query them as if they were merged, but doing so in a GDPR compliant way. It's a hard engineering problem, but anyway, I think it's so important that I backed a company to do it.
Great. And a great entrepreneur as well. Another theme that I've seen you talk about is complex real-time analytics at scale. That's something that you still focus on. So that would be, MemSQL and recorded future set machine, which are slightly older investments. Is that something that you still focused on?
Not as much.
Is that because the moment has passed for those businesses?
We're very happy that we made those investments, But I also think that the way that we look at, so I mean, I've written about all this stuff, but just to paraphrase, like we make relatively few investments each year. Each of us make 2 to 3 investments in a given year. Every investment that we are making, we think has the potential to be a multi-billion-dollar outcome. Every single one. That is the bar. With that lens, there are not too many businesses in that realm that clear that bar. And those are 3 really interesting, successful companies. I do not think one of them is going to cross that bar. Even though they'll be very good outcomes, we found in our kind of the power law reality of venture that we would much rather take 24 gigantic swings in a portfolio over a 4-year period and work, hopefully that 2 will be multiple fund returners and that the next 6, so call it 2 super performers, 6 good performers that cumulatively return 1 to 1.5x the fund, and then 16 some kind of outcome to shutting down to a low return of capital. That's kind of the model.
Actually, that elaborates on this just a little bit, as I, because I have conversations with this group on a regular basis. That's something like, unless you spend a lot of time, like in venture capital, that is very counterintuitive. This concept of power law.
Yeah.
Do you want to? I guess you alluded to it, but do you want to sort of double click on that and explain what it is?
Yeah. So just the notion that a very, very, very small subset of one's investments are going to generate almost all the returns. And so using kind of a blunt way of explaining it, you've got investors who believe strongly that the most important thing to do is to try and ensnare one of the Facebook, Airbnb, Dropbox, Square type companies. And they would rather own a minuscule part of those on the hope that they can get at least one of those in a fund. On the very far end of the continuum, the opposite way is me, which is, no, we're going to run a fairly concentrated portfolio, but that we are confident, and our track record has shown, that if we have the bar as high as the one that I just articulated, and we do the deep, deep work that we do very, very early in the game when there's sparse data, but we're able to get very significant ownership for relatively small dollars, that we can find a couple of companies in a fund that are going to enable us to generate the 3 to 5x net returns that we seek.
Very good. You want to talk about, you wrote some very interesting stuff about the type of founders, especially in that context of people that can build multi-billion-dollar companies. You had a couple of things that really caught my eye on, like founder qualities. The first one was a DNA that embraces experimentation. What does that mean?
So, we invest very, very, very early in a company's life. Again, very sparse data. Sometimes we invest, again, Trade Desk was a PowerPoint. I wouldn't say that's normal, but certainly very, very, very early product. So it's really around kind of aligning on the hypotheses. That's really what it comes down to. But a lot can go wrong, and a lot does go wrong all the time. So being able to have founders who, by their nature, want to run a series of constrained experiments to test these hypotheses and then to rapidly iterate as they collect data is, in our experience, an essential element to being a successful founder of a early seed stage company that has the chance of generating the outcomes that we're seeking.
Another one was a bias towards action.
So especially my partners who are orders of magnitude smarter than I am, we tend to back incredibly brilliant people. And this is something I know from my trading days when I managed hundreds of PhDs in math and physics. again, insanely brilliant, but sometimes afraid to act because they didn't feel they knew the answer, and they were reluctant to do anything unless they had the answer. The reality is, in seed stage venture, nobody has the answer. You're not going to get the answer for a long, long time. So again, you need to run these experiments. You need to be willing to fail. You need to take risk. If you've historically been the smartest person in the room, in the state, in the country, a lot of the way you're reinforced makes you really bad at that and really uncomfortable because you don't like feeling wrong. You don't like feeling stupid. So we try and thread the needle to find those people who are both insanely bright and capable, but at the same time embrace risk and aren't afraid of failure. So in our interaction with them, we try and create that dynamic where we spend a lot of time up front talking about these experiments, and then they run the experiments. And it's dispassionate. And if they don't work, they don't work. And that's okay. And we'll deal with it together. If they work, great. So anyway, that's...
How do you diligence that? How do you know when you meet somebody? It's not very hard to tell that they are incredibly bright in conversations and looking at a resume, but a bias towards action. How do you establish that when you meet someone?
I mean, a bunch of it is spending just a ton of time with them and talking about lots and lots and lots and lots of scenarios. And I think one of the things that we do is we like to see people in different settings and different combinations of people to see how they react. Obviously, talking to people from their background, we obviously do that, but I wouldn't say that that's necessarily the most effective means or the most powerful input. It's much more the experience of interacting with them around the hypothesis exercise and seeing them in these different settings. And we're wrong most of the time, so let me just be clear about that.
Talk about maximizers versus optimizers.
Oh, geez. Yeah, this is a pet peeve. Again, this is a characteristic of, again, I'm speaking in generalities, so don't take this as gospel, but in my experience, exceptionally bright people are oftentimes wired to maximize a variable. Do the most X, the greatest Y. When in reality, again, because there aren't these concrete answers that just show up very early in a company's life, there's this balancing act. There's, sometimes just getting 80% of the way there on V1 is perfectly fine. Not waiting until you think you've achieved 99%, but putting it out there, getting the shit kicked out of you, getting feedback, and iterating. Again, this also goes partly towards the bias towards action, but where you're able to step outside of yourself and say, I may be really bright, this is highly imperfect, that's okay. So focus on optimizing among the best as opposed to saying, no, this needs to be perfect. So again, that's something we actively screen for.
Yeah, and that emphasizes, just in case that was not obvious, to which extent the relationship between VCs and founders is deeply personal and human, and so many just purely human factors that come into play, which have to do with psychology and the way people are wired as opposed to what they actually do, which is fascinating. A little bit to this point, there's a whole trend that in our bull market that has kept on going for many years, has developed in the venture community, which is this whole concept of being founder friendly. And I guess that's in opposition to what happened maybe a decade or two ago, where the power dynamic between investors and founders was different. But I think you have some interesting thoughts on this. When is founder friendly to founder friendly, and when do you abdicate responsibility?
Sure. Yeah, Matt's really hitting on these tough points. I think I write too honestly. So yeah, founder friendly. So I think founder friendly has become associated with being permissive and being loose as it relates to documentation, as it relates to founder expectations, as it relates to founder egos. I think that is actually being very founder unfriendly, because especially when, like I'll say in our case, most of our founders are first-time founders. You know, like we're not Sequoia and Benchmark, and we're only 8.5 years old. So we don't have the stable of entrepreneurs that have exited that are onto their next thing. So by definition, we are largely dealing with first-time founders. And even repeat founders, they have a lot to learn. And we all have a lot to learn together. There's some things they know really well, like the product and the vision. There's some things we know from having this enormous data set of having worked with lots and lots of companies and seen lots and lots of failure modes. And so what we work really, really hard on, again, by spending a lot of time up front with founders and building that deep trust relationship, that enables us to be very honest and very blunt along the way. It's not personal. It's we're trying to help founders be their best selves. That's not really possible if you're not giving them challenging feedback. Does that necessarily mean that you're not founder friendly? I would argue it's the converse, but that's against popular lore. Or, you know, and honestly, I'll just say it, it's against like the YC ethos. Like, I don't think in many ways that attitude of it, you know, it's founders versus investors, keep investors at arm's length, is really healthy. I actually think that's really shitty and does founders a great disservice. And has it worked in certain cases? Sure. Does it work in most cases? Not in my experience.
Interesting. All right, I guess we almost out of time, so I want to open up to questions. This one over there.
Yeah, I guess since you're also an illustrious fellow City alum, I have to ask relative to your fintech investments in Simple and TransferWise, would the thing that you said about InfoSum also apply to them? So, you know, would you still consider investing in direct-to-consumer fintech ventures? You know, myself being the founder of one, but what has changed there? And is direct-to-consumer fintech still a viable investment proposition vis-a-vis the power law?
I would say it's possible. I would say we've looked at hundreds since the days that we did those two investments and have not found anything that has really met that threshold. So is it possible? Yes. Is it probable? Not based on what I've seen. So I take that as you will. You want to send me something, I'm happy to look at it. Roger at iaventures.com.
Okay, hi. My question is a bit tangential, but still something that I'm interested in. Considering you do venture capitalism and blockchain technology is such an emerging technology now, and whereas you've been focusing primarily on companies that seemingly are working with centrally managed data. Mm-hmm. When there are companies that are being founded that are looking at blockchain centralized data, how do you evaluate them, or do you consider them, considering their models seemingly so different from traditionally supported or backed?
It's a great question. I meant to ask earlier. So no crypto?
By the way, that was not a tangential question. That was an excellent question. So we have not done anything in the crypto space. I actually view her question as being slightly different. We have looked, and I am actually looking at a company using a form of blockchain to achieve something that one couldn't do with a centralized database. So I am in. My partners are not at all interested in this. I'm interested in this. So I could see investing in a business that is using the concept of blockchain as an enabling technology. We will not do anything in crypto or tokens.
Good. All right. I think we actually right on
cool.
time. So this is perfect. Thank you so much. Really enjoyed it.
Pleasure.